The UK property market in 2026 is not one market. It never has been. But right now, the gap between the best and worst performing regions is wider than it's been in years. And if you're buying, selling, or investing and you're not paying attention to where you're looking, you could be making a very expensive mistake. Today, we are breaking this all down using the freshest data available, straight from the Land Registry, Nationwide, Zoopla, and more. Where are prices booming? Where are they falling? And where should you actually be looking right now? Let's get into it. First, let's set the national picture so we all know what we're working with. The average UK house price currently sits at around £268,000, with annual growth of 1.2% as of February 2026. That sounds reasonable. Modest but steady. But here's the thing. That national average is almost meaningless when you look at what's happening underneath it. Because house prices grew fastest in Northern Ireland, Yorkshire and the Humber and the North East, while prices actually fell in London, the South East and the South West. So we have a country that is genuinely splitting in two right now. The North is gaining, the South is losing, and there are some hidden pockets in between that most people are completely ignoring. Let's go through them one by one, starting with the single best performing area in the entire UK right now, and that is Northern Ireland. Northern Ireland was the best performing area in Q1 2026, with prices up 9.5% year on year. That is not a typo. Nearly 10% growth in a single year. And when you drill into the local data, it gets even more striking. Properties in Mid-Ulster are up 10.7%, and in Newry, Mourne and Down prices are up 12.4%. Double-digit growth in specific areas, at a time when most of England is limping along at under 2%. The average property price in Northern Ireland now stands at £195,936, which means you are getting some of the strongest growth in the UK combined with one of the lowest average entry prices anywhere in the country. That combination is genuinely rare, and it's the reason more investors are starting to pay serious attention to Northern Ireland. Coming in right behind it is Yorkshire and the Humber. The highest annual growth among all English regions was in Yorkshire and the Humber, where prices increased by 3.9% in the year to February 2026. The average house price across the region sits at around £209,000, well below the national average. So again, you've got affordability working in your favour alongside solid price growth. Savills are forecasting Yorkshire and the Humber to be one of the top performing regions not just in 2026, but over the next 5 years, with projected cumulative growth of 28.8% to 2030. That is the kind of long-term data that should make any investor sit up and take notice. Cities like Leeds, Sheffield and Hull are all benefiting from continued investment, improving infrastructure, and people relocating from more expensive parts of the country looking for value. Third on the winners list is the North East. The North East recorded the highest monthly house price increase of any region, with prices up 2.7% in the year to February 2026. Now that might sound smaller than Yorkshire or Northern Ireland, but remember, the North East is coming off a very low base. Average prices here remain among the cheapest in England, which means yields for buy-to-let investors are often significantly stronger than you'd find in the South. Savills also forecast the North East to deliver 28.8% cumulative growth by 2030, putting it level with Yorkshire as the joint top-performing English region over the next 5 years. Sunderland, Middlesbrough, Durham. These are places where your money genuinely stretches further, and the growth trajectory looks strong. And we can't talk about the winners without mentioning one surprising entry: Ceredigion in Wales. In the 12 months to February 2026, house prices in this remote Welsh county gained 11.4%, beating the national trend and continuing to draw demand despite wider market headwinds. Ceredigion sits on the west coast of Wales. It's rural, it's affordable, and it appears to be attracting buyers looking to escape city life. It might not be on everyone's radar, but the numbers speak for themselves. Now, let's flip it around and talk about the worst performing areas, because this is just as important. And the big one, the elephant in the room, is London. London house prices fell by 3.3% in the year to February 2026, with the average property now valued at £542, zero, a 3.3% annual decline. In a city where average prices are over £500,000, that represents a significant amount of money being wiped off values. And it's not just a one-month blip. High borrowing costs and a wealth exodus are weighing heavily on expensive London homes, particularly at the higher end of the market. The outer southeast also saw a price drop of 0.7%, and the southwest has similarly recorded falling values. So why is London struggling while the north thrives? There are a few reasons. Mortgage rates going back above 5% have hit affordability hardest in the most expensive markets, and nowhere is more exposed to that than London. When US and Israeli forces struck Iran in February, swap rates surged. Banks and building societies withdrew over 1,500 mortgage products in under a fortnight, and two-year fixed rates climbed from around 4.8% to about 5.5%. Higher rates hurt expensive markets disproportionately. Someone buying in Burnley at £129,000, which by the way is the cheapest area in England to buy right now according to Land Registry data, feels that rate rise very differently to someone trying to buy in Kensington and Chelsea at £1.02 million. There's also a supply issue in London. Estate agents have warned there is currently a decade-high number of homes on the market, and a third of homes already listed have had their asking price reduced by an average of 7%. That is a buyer's market if ever there was one, at least for those who can still access mortgage finance. And interestingly, some analysts think this could actually present an opportunity in London over the medium term. A reported one in 8 British nationals have already departed from the Middle East since the start of the Iran conflict, and the Treasury is hoping more will return. A potential influx of Brits from abroad combined with falling London prices could prove to be a catalyst for a bounce back. So what's the overall takeaway from all of this? The data is telling a very clear story. The North and Northern Ireland are where the growth is happening right now. Affordability is better, yields are stronger, and the long-term forecasts from the major agencies back it up. The top-performing regions over the next 5 years, according to Savills, are Yorkshire and the Humber, the North East, Scotland, Wales, and the North West, all forecast to deliver growth well above the UK average of 22% over 5 years. Meanwhile, London and the South East, whilst they may recover in the longer term, are facing very real short-term headwinds with no immediate sign of a turnaround. If you're a first-time buyer looking for value, if you're an investor chasing yield and growth, or if you're simply thinking about where to put your money in property right now, the data points north. That doesn't mean London is done forever, but right now, in May 2026, the numbers don't lie. The best opportunities in UK property are not where they were 10 or 15 years ago. They've moved. The question is whether you move with them. That's everything for today. If you found this useful, make sure you subscribe so you don't miss our next update. And drop a comment below telling me which region you're watching right now. I'll see you in the next one.